It's been a much tougher week on equity markets. The FTSE 100, which we're looking at here, started the week at around about 6,000. And as you can see, it's moved down on this chart 5869. In fact, the real time it's moved down to the 5,800 level. The impacts this week have been really the same sort of stories from last week. I think we were commenting about how robust the market was holding up against the Middle East concerns, but as I say, this week those concerns have heightened somewhat, and we've also had some disappointing earnings data. And finally, we've just receiving news as we speak of this earthquake that's hit Japan, and that is beginning to have a gradual larger impact on equities. So as I say, we're seeing the FTSE back down to about 5,800. I think one of the sort of key stories for me last week was the retail sector. We commented last week about the sharp underperformance in equities in the retail sector. And this week we're now starting to see the news flow, which I think is supporting that downward revision. Home Retail, which owns the Argos chain, has reported the profits will come in below expectations. Downgrades being seen there of about 10 to 15%. But you can see on this chart here the impact of that sort of chart movement from the sort of beginning of 2011 and that very sharp downward correction that is seen in the course of the last week. Now, what I'm hearing from retail experts is that life on the high street is extremely tough at the moment, and much tougher than I think the market has even priced in at this stage. It's really affecting the discretionary end of the market, that item that you may pop into the shop and buy or may not, or leave it or defer it. Well, at the moment they're deferring it, and I'm hearing of like-for-like sales performances of at least 10% and approaching 15% in those discretionary ticket items. Now, that means, I suspect, that over the course of the next few weeks and few months, we are going to see more and more profit warnings in the sector. The argument is how much has been discounted. Markets do move very rapidly to reflect, say, Home Retail's profit warning into their own sort of other companies within the sector. So I suspect that next week we'll see further weakness in the retail space. And for traders, and I suggest traders at this stage, it may be an opportunity to pick up, as I say, some of the quality names into any sort of further weakness, because there has been a large derating. But be under no illusion, the retail sales numbers at the moment are very poor and may, as I say, just change that base, that question mark over when interest rates will go up into the UK market. Just turning to other companies that have performed well this week, Prudential performed very well on some great numbers that we saw earlier this week. We saw that sharp rise. I will say that some of that's been reversed on the back of this Japanese earthquake. All the insurers are naturally going to be hit on the back of that. Whether they will ultimately be impacted is another question, but sentiment means that they will be impacted. But underneath it all, Prudential is performing very well at the moment. A quick look at oil. Obviously, the tensions that are heightening now in Saudi Arabia, to some extent, hasn't really impacted further on the oil price. You can see over the course of the last week that there has been a little bit of driftiness there. And at the moment, that oil story has slightly taken a sort of back seat. It may come back again for next week. And just in terms of some of the stocks that we're following and provide coverage on, we are bullish on Imperial Tobacco. There has been a move, certainly we saw Morgan Stanley this week, to increase weightings towards some of the defensive sectors. And Imperial Tobacco is on our buy list. We're not necessarily looking for huge upward performance, but we do think the stock looks very cheap, supported by a very comfortable dividend yield here. So certainly, as I say, that came out this week. We've got two technology stocks that we've either published or updated our research on. A new company research note is Juniper Networks, which really is trying to take advantage of the rapid rise in data across the internet and across the networks. Juniper is a great play, and we're also updating Apple. That we still think that when you strip the cash balances out of Apple's valuation, the multiple still looks very cheap. And with the launch of the new iPad 2, there was a little bit of hot money ahead of the iPad 2 launch, which is naturally coming out, but there will be a time to buy that. I suspect that technology may find itself over the next week or two just coming under a little bit of pressure. Some of the semiconductor groups have come under a bit of pressure, and if that does drag names like Apple and Juniper back just 5% or so, 10%, there'll be some good opportunities to buy into those stocks.